Welcome to Credit Union Financials 101, brought to you as a value of affiliation through the League of Southeastern Credit Unions and Affiliates. Let's start off by taking a look at the regulatory requirements required from directors around financial literacy. At a minimum, directors must have at least a working familiarity of basic finance and accounting principles, including the ability to read and understand a credit union's balance sheet and income statement while asking as appropriate questions. While those with this knowledge do not have to take a class or test, it is possible for an examiner to request a director who is not to demonstrate how the balance sheet and income statement work together. At a minimum, directors should be able to examine the balance sheet and income statement to answer the following questions. What does this line item mean? Why is it important? Is the value of this line item changing over time? And if so, what does that change mean? As a director of a credit union, we must always focus on the best interests of our membership as a whole and continue to serve our mission as not-for-profit financial cooperatives, living through our 7 cooperative principles. Through the cooperative principles, a credit union's primary purpose is not to seek the biggest possible profit, nor is it appropriate to seek asset growth for the sake of growth. Instead, the primary purpose of a credit union is to provide quality, low-cost financial services to members most in need. When reviewing financial resources for the board, it's important to remember that the National Credit Union Administration issues quarterly financial performance reports for federally insured credit unions. The League of Southeastern Credit Unions then utilizes that information to produce quarterly custom performance reports, which compare your credit union's performance to credit unions across your state, NCUA Southern Region, and across the country. This information is sent on a quarterly basis to the CEO of your credit union, and please do not hesitate to reach out should you have any questions or need access to the information. Next, let's dive into the various risk categories of a credit union. Starting off with our CAMELS rating system. In order to perform duties in a meaningful manner, directors should understand the 6 critical elements and corresponding risks found in depository institutions, broken out into market risks, which are quantitative risks, including credit, interest rate, and liquidity, followed by institutional level risks, which are qualitative and more subjective. Those include transactional risk, compliance risk, strategic risk, and reputational risk. Your credit union's examiner will measure the critical elements of operations by these factors in order to create an indicator of viability between 1 and 5. 1 means the credit union's operations are sound in every respect, and as your CAMEL rating continues to increase, so does the examiner perspective of unsafe and unsound principles. Your credit union's CAMELS rating is shared only with your credit union, and it breaks up into the various categories we will move into next. The C of our CAMELS rating comes from capital. A credit union's capital should be commensurate with the extent of risk and the ability to identify, measure, monitor, and control these risks. It's important to note that regulatory requirements that state our minimums are separate from capital commensurate with the level of the credit union's specific inherent risks based upon an assessment of the following. This includes the overall financial condition, ability to address emerging needs for additional capital, the quality, type, liquidity, and diversification of assets, loan and investment concentrations, growth plans and past experience managing growth, volume and risk of new business initiatives, ability to control and monitor risk, field of membership, and the overall macroeconomic environment. The A of our CAMELS ratings comes from asset quality. Asset quality is defined by the existing and potential risk associated with loan and investment portfolios, alongside a credit union's ability to identify, measure, monitor, and control these credit risks. Any risk that may have an impact on the value of assets should also be considered as a part of asset quality based upon an examination of the following. This includes the quality of underwriting policies, procedures, practices, the internal controls that are utilized to review new loan programs, high concentrations, and changes in underwriting, the adequacy of our allowance accounts and other asset valuation reserves, the ability to properly administer assets, including timely identification and collection of problem assets, existence of significant growth trends indicating erosion or improvement in asset quality, and existence in concentrations that present undue risk to the credit union. The M of our CAMELS ratings comes from management, defined as the capability to identify, monitor, and control risks that ensure a safe and efficient operation that remains within compliance of all applicable laws and regulations. While our directors need not be actively involved in day-to-day operations, our directors establish acceptable levels of risk exposure through policies, procedures, and practices set at the board level. Management ratings are based upon an analysis of the following, including adequacy of policies and procedures, budget performance compared against actual performance, effectiveness of systems that measure and monitor risk, risk-taking practices and methods of control, integration of risk management with planning and decision-making, compliance with laws and regulations, appropriateness of products and services offered in relation to size and experience, market penetration, disaster preparedness, and succession planning for key management positions. This is outside of only the CEO level, but truly a look at the overall management of the credit union in the various positions and departments. The E of our CAMELS ratio comes from our earnings. This is defined as our adequacy to fund capital commensurate with our financial and operational risk, economic changes, and strategic plans. As our earnings can be affected by inadequately managed credit risk that may result in losses, or market risk that may unduly expose earnings to volatility and interest rates. Our future earnings may also be adversely affected by an inability to forecast or control funding and expenses, improperly executed strategies, or poorly managed exposure to other risks. Earnings are based upon an assessment of the following, including quality and sources of earnings, ability to fund capital commensurate with current and prospective risk through retained earnings, adequacy of valuation allowances, budgeting systems, forecasting projects, processes, and management information systems, future earnings adequacy under a variety of economic conditions, quality and composition of assets, as well as earnings exposure to market risk and material factors affecting the credit union's income producing ability, such as fixed assets or other non-earning assets. The L of our CAMELS ratio represents liquidity. Our liquidity rating is defined through risk management practices, ensuring maintenance of sufficient funds to meet our obligations and member demands, while also reflecting our ability to manage unplanned changes in funding, changes in our ability to quickly liquidate with minimal loss, and limit reliance on outside sources, commensurate with the complexity of our balance sheet and capital adequacy. Liquidity ratings are assigned based upon an assessment of the following, including trends and stability of deposits, adequacy of liquidity sources compared to present and future needs, availability of assets readily convertible to cash without undue loss, access to sources of funding, level of diversification, degree of reliance on short-term volatile sources of funding, as well as the capability to identify, measure, and control our liquidity position, including our effectiveness of set strategies and policies. And finally, the S of our CAMELS ratio, the newest addition to the ratio, represents our sensitivity to market risk. Sensitivity to market risk reflects our exposure of current and prospective earnings and capital that may arise from changes in market prices and interest rates. Effective management includes ensuring interest rate risk policies, risk limits, and mitigation strategies and governance framework. Sensitivity to market risk is based upon an assessment of the following, including sensitivity of earnings and value of capital to changes in market prices and interest rates, management's ability to identify, measure, monitor, and control exposure to market risk, considering a credit union's size, complexity, and risk profile, arising from repricing risk, basis risk, yield curve risk, options risk. Additionally, sensitivity to market risk also factors interest rate risk affecting the price of investments, the value of loan portfolios, and fee income, all sensitive to changes in interest rates. Now that we have an understanding of the risks apparent and existing within our credit unions, we now can take a look at our two sets of financial statements, our balance sheet and our income and expense statements. Our balance sheet is showing our credit union's financial position at a specific point in time, while in contrast, our income statement is providing our financial performance over a period of time. Our balance sheet provides us with a summary of assets, liabilities, and capital, while our income statement summarizes income and expenses, or our gains and losses. Jumping into the fundamentals of balance sheets, we start off with our assets, defined as what we own as a credit union. You can see the various categories of assets, including loans, what is owed back to us, our allowance for loan and lease loss account, which is contra to our loan accounts and what we need to cover loans we may lose in the future. Cash, including money for daily activities or on hand. Investments, where excess cash is invested for income to the credit union. Prepaid expenses paid in advance for items used over time, such as bond insurance. Fixed asset items used during normal business, such as furniture and equipment. Our National Credit Union Share Insurance Fund deposit with the NCUA for our credit union share insurance, as well as other account receivables or other items expected to receive in the future. In contrast, our liabilities are what we owe. This may include our accrued dividends to pay out to members in the future, other accrued expenses, defined as items not charged for but incurring, such as audits, accounts payable items to pay in the future but have already received benefit, like our phone and power bills, regular shares in the form of member deposits, as well as share drafts, IRAs, and other club accounts for savings or daily use. This then leaves us with our credit union's equity, or what we are worth. Our normal income is closed in our undivided earnings, also part of our retained earnings for net worth purposes, and all net income is closed here when books are closed at quarter end. We also have our regular reserves, where money earned over time is closed to continue building our net worth. We also have our income and expense statements, which breaks down what we earn in forms of income, which can be loan income as far as income received from interest on loans, as well as investment income, fee income, such as non-sufficient funds and dormant accounts, as well as other income earned by the credit union, such as interchange. In contrast, expenses may come in the form of compensation and benefits, office occupancy, office operations, or cost of doing business, things like the phone bill, professional and outside services that are paid to others who provide specialized services, such as audits. Our provision for loan and lease loss expense is what is expensed to fund the allowance for loan and lease loss account. The dividend expense paid to members for use of their money, as well as any other expenses not detailed. When we are able to add all income from the income statement with all expenses on the income statement subtracted, this provides us with our credit union's net income, which is then close to undivided earnings when the credit union closes its books. You may be aware of the many ratios present and important in credit union land, but let's dive into a few of those key ratios, starting with our credit union's net worth. This is a critical ratio for examiners, which measures capital adequacy and the primary measure of a credit union's financial strength. This is calculated by taking a credit union's total equity divided by total assets to create a net worth that continues to grow through the credit union's profitability. This can also be seen as our credit union's rainy day fund, as when we take strategic risks that we hope benefit our credit union and our membership, this allows the cushion to allow for those calculated risks. Outside of our regulatory required minimums, the amount of net worth that is enough depends on the individual credit union's risk profile. We also have our loan to assets ratio, which is a liquidity ratio in which a high ratio may stress liquidity, especially if a credit union has limited funding sources or minimal short-term investments. In contrast, a low ratio may signal additional lending opportunities or inflated deposits, possibly through marketing efforts or loan and deposit rates and types. This ratio is calculated through dividing total loans by total assets. Our goal is to find the sweet spot comfortable for our credit union between liquidity and efficient lending. We also have our delinquency ratio, measuring our loan to asset quality and the current credit risk of the loan portfolio and the forecast of future losses for our credit union. Calculated by dividing delinquent loans by our total loans, this ratio is affected by our loan and collections policy, loan portfolio, and overall economic conditions. Our goal is to achieve a sustainable level dependent upon our credit union's income and risk and loan loss management tolerance. We also have our net charge-off ratio, representing the percentage of assets lost due to annualized net charge-offs. High net charge-offs directly impact the credit union's income statement as they are funded through the provision for loan loss account and calculated by subtracting the annual charge-offs from our annual recoveries and dividing by our average total assets. Our net charge-offs are affected by our credit union's loan and collection policy, loan portfolio, and economic conditions. The cost of funds ratio reflects the percentage of assets used for dividends and interest on borrowed money. In other words, how much is spent acquiring funds to lend to members. Our cost of funds ratio is determined by our market conditions and mix of deposits between lower cost regular shares and higher cost CDs. Our cost of funds ratio can be calculated by adding our dividend and interest expense divided by average assets. Our annualized net interest margin measures whether our income from loans and investments is sufficient to cover the cost of funds. Impacted by our execution of lending and liquidity strategies, This can be calculated by subtracting the total interest income minus our cost of funds ratio divided by our average assets. Credit unions with lower operating expense levels or strong net interest margin will generally be able to sustain more competitive loan and deposit pricing strategies. In contrast, credit unions with higher expenses, loan losses, or lower net interest margin levels will usually need to maintain higher net interest. The operating expense to gross income ratio reflects the percentage of income used for operations. As every dollar of income, a percentage goes out the door in operating expenses. This is a ratio that measures efficiency, where the higher the number, the less efficient a credit union may be. However, this does not indicate financial health, as more branch-heavy operations or expensive or competitive markets come into place. Our credit union's return on average assets ratio is an earnings ratio measuring net income in relation to average assets and further represents the credit union's bottom line. In other words, this is our profit after daily operations. Be taken by our annualized net income divided by our average total assets, in which a positive ratio shows earnings were sufficient to cover operating expenses and cost of funds, while a negative ratio may show the opposite and further promotes the importance of a strong capital base. Our annualized growth ratios include loan growth, asset growth, and share growth, in which each category you take the total in the current year minus the total in the prior year divided by total the year before. This is represented through the board of directors' philosophy towards service, delivery, pricing, and service offerings, represented through the credit union's growth strategies. In conclusion, directors should review basic ratios on a monthly basis and incorporate these numbers into their decision-making processes. Also, ensure that you are taking a look at trends over time, know which direction is positive, and ensure that you take the time to compare balance sheets and income statements to prior years and question anything out of line or major discrepancies. It is also great to utilize peer comparisons, but also understand why you may deviate from peer. Thank you for your time attending today's financial literacy training for directors, brought to you through the League of Southeastern Credit Unions and Affiliates. Should you have any additional questions or needs, please don't hesitate to reach out to member engagement at lscu.coop. Thank you so much.